Welcome to this new series of long-form videos where I'll attempt to break down complex topics and core principles for anyone to use. The chapter of today is Investing 101. Good luck. If you're the person who are putting all your savings under the couch or in a checking account, you absolutely need to see this video because I'll give you a step-by-step initiation so that you can start growing your money today regardless the amount of money that you have. As many of you know, I'm an artist and musician, and I was lucky enough to understand the importance of knowing how to manage your own money since I was in college. The principles I want to provide you are the ones that I've studied over the past 3 years while diving in the art of investing. I want my brother, my girlfriend, and all my friends to start using some of the strategies that I'm using myself. To understand why investing is so important, first we have to dive into the compound effect. Let's say you're saving $3,000 per year. Now, in this column, you would see how that money accumulates over the years. In this column, what I want you to see is that you can compound that money with a 10% of return if you invested that money. What I want you to notice from this chart is that on year 5, you would have 22% of additional savings. And if you stick for the long term, by year 30, you will have 448% of additional savings. So the first strategy I want you to use is buy and hold. And to understand why is it so effective, let's take a look to the last 200 years of the stock market. Between 1825 and 2013, the market had 134 positive years and 55 negative years. That means the market was up 71% of the time. And it also means that the market has a down year every 3 or 4 years. What I want you to notice from the graph is that the market over the past 200 years have been expanding. That means that by just getting into the market and holding, your money will compound over time. I know you might not feel confident choosing what to buy. We don't know what industries are going to increase in value: tech, transportation, and within those industries, what companies? Apple, Audi, and what asset classes? Is it real estate? Is it commodities? Is it bonds? Market timing, meaning when to buy, when to sell, and individual security selection, knowing what to buy, is extremely difficult for the average investor and leads most of the people with very poor results. So my advice for you is to buy the whole market. How are you going to buy the whole market? Well, by buying ETFs, also known as exchange traded funds. For example, the S&P 500 is a stock market index that comprises 505 stocks issued by 500 large cap companies. The average rate of return of ETFs, such as the S&P 500 over the past 15 years, have been between 8 to 10% annually. The two main reasons why it's so effective to have ETFs at the core of your portfolio is because first, they give you broad diversification, and you want to diversify to minimize risk. Diversify how? Buying different companies in different industries, different market countries and currencies, different asset classes, and across time. Owning more than 15 uncorrelated assets can reduce by 80% your risks and can maximize your returns up to 5 times. You can buy ETFs of stocks, commodities, bonds, real estate, etc. The second reason is because ETFs outperform active managed accounts. 89% of active managed accounts fail to outperform passive funds such as the S&P 500 on a relative basis over the past 15 years. Also, active managed accounts overcharge for underperformance. They risk your money without any guarantees of giving you a return, and even if they do, their excessive fees will eat all your profit. Let me tell you, the platform that I'm using today to do my investments is called Robinhood, and it has a couple of advantages. The number one advantage is that you don't need any money to open an account. It has what is called fractional shares, which is a portion of an equity. That means that you can start investing from $1 on your favorite companies or buying index funds or ETFs. You won't pay any commissions or fees per transaction, but also offers what is called a high yield savings, which means that any money that you have in the platform that you haven't invested yet will give you a 0.30% yield of interest. Think that many of the banks, like Bank of America, will give you 0.01% for whatever money you have in that account. You can buy stocks, options, ETFs, and even cryptocurrencies. Now, even if you want to explore other platforms, or maybe if Robinhood is not supported in your country, look for a platform that will give you these same benefits. Some others that I would recommend are Vanguard, TD Ameritrade, Charles Schwab, or Fidelity. If you decide to go with Robinhood, you can send me a direct message and I will send you a referral link in which you will earn a free stock just by signing up. For further interest, if you don't want to just buy ETFs and you want to dive deeper, here are some concepts I want you to keep in mind. For one, start learning technical analysis, how to analyze a graph, so that you can start identifying the high points and the lows, so that always you buy low and sell high. Number two, as a good rule of thumb, don't own securities that do not provide dividends. Dividends is a sum of money that is paid by the company to its shareholders in a quarterly basis. Number three, always have a strategy in mind. Have always the entry points, when are you going to buy, and your stops clear, when are you going to sell. Usually what happens is that once people enter to a market, they start being controlled by their emotions and no longer by their strategy. Either because of greed or because of fear of losing, they get out of their initial strategy. Number four, take into account that if you sell an asset within less than a year, you will pay ordinary income tax, which is higher than if you keep it for longer than a year. Number five, the rule 5-to-1, asymmetric risk reward, which means you will always go for a reward that is 5 times higher than what you're willing to risk. That way, even if you are 80% of the time wrong, you still won't lose money. Number six, design a portfolio that is based on your own needs. You cannot just copy the portfolio of other people because everyone have different needs. Where you are in life, how much can you save, how much money are you expecting to get in return, and when do you need it for? Here are some percentages that I'm using that might be useful for you. Invest 10% of every check. No more than 5% on any company. No more than 20% on the same sector. If you're buying ETFs, go for 60% domestic, 40% overseas. And finally, keep always 10% in cash in case you need it. Before we get to the closure of this video, I want to go through some common mistakes that investors do. Mistake number one, confirmation bias. That means looking for information that supports your belief while not welcoming opinions that contradict your own. Mistake number two, recency bias. Mistaking a recent event for an outgoing trend. Number three, overconfidence on your ability and knowledge. Number four, greed. Looking for an opportunity to make a lot of money in a single transaction. And rather, my invitation is for you to do thousands of transactions that give you a small return on them. Investing is a marathon. It is not a sprint. Also, have in mind that excessive trading can be a disaster. Don't check the prices of the stocks and funds on a daily basis, because that becomes addictive behavior. Also, careful, filter the information from Wall Street firms that in the end want to sell you a product or a service. They don't want to share wisdom, they just want to create movement, action in the market. Rather, I advise you to study the principles from legendary investors. Number five, negativity bias. Means taking a negative outlook of the market. We know that corrections happen in average once a year, and the market crashes in average between 3 and 5 years. Now, if you are in for the long term, there's nothing you should worry about, because as we saw, market expands over time. And preparation is key. As long as you are well diversified, there's nothing to worry about. Also, think that in the market crashes is a great opportunity to build a lot of wealth. My invitation is that you start seeing investing as another skill, just like learning a new language, getting fit, learning how to play a musical instrument. It's not more difficult than that. Once you understand the rules of the game, it's very easy for you to win. It's all about saving and the compounding interest. And if you stick for long enough, you will always win. It's also an emotional game, because once you get into a market, if you get controlled by your emotions, you will get out of your strategy. I hope you got anything from this video and that you start applying whatever concepts you learned today. Good luck.
Hey everybody, thank you so much for watching this video. If you haven't already, consider giving me a thumbs up, sharing this video, or subscribing to this channel. Until next time.